Hi, everyone. Thank you so much for joining us today. Glad to have you all back for a webinar with Rocket Dollar, one of our partners. We're so excited to have Mark Peck, Director of Business Development at Rocket Dollar, here today to speak with us about utilizing your self-directed IRA to invest in more than just stocks and how they help you do that. When we started KingsCrowd a year ago, one of the big things that we wanted to focus on was ensuring that we provided our users with every tool, not just ratings and analytics, to be able to make informed investment decisions and find ways to grow your overall wealth portfolio in an optimized way. And we really think that Rocket Dollar is one of those tools that helps you do that. They've been a wonderful partner to us, and we hear questions all the time from our users about, what is Rocket Dollar? How do I utilize it? And how can this help me invest efficiently? And so we've decided to put this webinar together to answer some of those questions. So with that, we'd love to hop in and introduce Mark and have him tell you a little bit about himself, and then we will begin with some questions regarding Rocket Dollar.
Terrific. Thanks so much, Chris. Great to be here with the KingsCrowd Network and really excited to talk about this topic here today. I myself have been a part of the alternative asset investing space, and in particular on the self-directed retirement side for just about 10 years, both as a user and consumer of the products available in our space, as well as on the business side, offering those out to the marketplace. I was really excited and enthusiastic to join the Rocket Dollar team when we launched last year, because we felt like there was an opportunity to really refine and evolve the self-directed products that exist out there in the marketplace. So our goal is really to offer an efficient and flexible tool that gives maximum control to the client and the investor and really helps them interact with the whole spectrum of alternatives.
Excellent. So for people that have never, really heard of a solo 401k or a self-directed IRA, can you tell us a little bit about what the heck these mechanisms are for investing your money?
Yeah, absolutely. So we are playing by the same retirement guidelines that any other provider is using, whether that be a 401k you have an employer with Prudential, or maybe a trading IRA you have at Charles Schwab. We're all playing by the same rules of the road. The issue is about the way that you get access to and the way that you control the retirement account and the choices that it makes. And that's where that term self-directed comes from. And really what self-directed is referring to is the ability to invest beyond market traded securities into private assets, hard assets like real estate, early stage companies, from a startup perspective. And self-directed is really just that idea that the customer, the account holder, has full control over the account decisions. And so we offer a unique structure that really helps maximize the efficiency of the tool by providing what's referred to as checkbook control for each and every account that comes through our door.
Got it. And that makes sense because I have a company IRA from the last company that I worked at, as well as a 401k. And essentially, the only decisions I have are to purchase whatever other mutual funds they have within the account. And basically, that's the only thing I can invest in. There's not even a button to consider investing in anything other than the stocks that they provide to you. So you're saying that this is essentially an opportunity to manage your own investment account with your retirement dollars and invest in things that you care about outside of just whatever mutual funds your company is providing.
Yeah, that's absolutely right. And I think what is in particular so powerful for each and every person who's considering these types of accounts is that what it really lets you do is make very specific and strategic investments in an asset class or a geography or something that you're passionate about, right? If you're from the Southwest and you want to invest in a particular, product or theme that's happening in that part of the country, using that granular level beyond
IRA or solo 401k.
Yeah, so part of our value proposition is really a flat and transparent price. We feel that these accounts should really be handled more like a financial subscription at this point than a fluctuating fee that is assessed based on your activity or the assets that you hold with us. Ultimately, we want to reward and be open to any and all users of our platform, irrespective of the number of assets or how many transactions they make. So our value proposition and our fees start with $360 to get started, which is a lot of where our upfront work is done to really, get the full infrastructure set in place for the client, and then a flat ongoing fee of $15 a month. So we don't charge for transactions. We don't charge based on the
Actually, what you're paying is a fee to have an account with Rocket Dollar. Is that correct?
That's right.
So you could have $1 million in that account, you could have $5 million in that account, and all you're going to spend is $180.
Exactly. Or on the other side, you could have $5,000 in the account and just be building, and beginning that journey. Either way, we want to make it accessible to both sides of the spectrum.
So can you give us a little bit of a sense, because I don't think people necessarily realize just how much fees can add up. So on a traditional IRA, a lot of times there's a percentage fee, right? It could be like 1 or 2 percentage point, or maybe something smaller, I don't know. But just kind of talk about how this ends up being a much more valuable way or less cost-based way of investing your dollars in an IRA.
Yeah, I think what traditionally has been very difficult to wrap your mind around as a consumer in this space is the fluctuating fees. So often, let's say you made 2 investments in this particular year, you'd be charged a higher rate for making those 2 individual transactions, whereas next year, if you make no new investments, your fees are going to be lesser. And so there's a constant variation that makes it hard to sort of gauge what you're really going to be paying and then what the value is back towards you. And so you're absolutely right that there's often an assets under custody fee that is tagged based on the number and value of the assets in the account. And then I think even more frustrating than that is really when you go out and build a portfolio, and let's say you invest in 4 startup vehicles that you found through KingsCrowd, those 4 different transactions are going to result in a higher fee for you for each deal. Whereas in our model, we want to give you the tool to go out and make those 4 transactions and create a portfolio without being dinged for that work.
Got it. So instead of in a year, maybe you end up spending a few grand on fees or something, you always know you're spending that 180 and that's it.
That's right.
Okay. No, that makes a lot of sense. That's really helpful. So for some people, they might not have heard of a self-directed IRA, and, this idea that you can invest in anything and there's all these alternatives, AKA non-stocks, right? That you can invest in using your retirement account. Can you talk a little bit about that?
Yeah, so again, the rules of the road are the same for all retirement account providers. It's a situation where the business is making decisions about what you can hold and what you cannot. And so, the Wall Street model and the traditional retirement model doesn't want to include these outside assets that are unique and one-off situations sometimes. Their goal is to package and securitize, large volumes of assets and products and put get huge numbers into those selected items. And so it doesn't benefit, the large advisors and broker dealers of the world to offer these non-traded and non-solicited assets. And so really what you come up against is this idea of non-solicited. That's where an advisor or a broker may sell you a particular product and then make a cut or a commission off that transaction. So in our case, in Rocket Dollar, and this is true for all the self-directed space, we're not selling you a security or an investment, nor are we making any money off that transaction. It's simply about providing the tool. And so since we're providing the tool, we're asset class agnostic, and we want you to, follow your
Mark?
Yeah, so we lose it there a little bit, Chris?
Hey, yeah, I think we lost you there for a second. It looks like you're back now. I'm sorry, if you could just back up about 10 seconds and continue to fill us in. So for the kind of the...
Yeah, so sorry that we lost us there. I apologize.
No problem.
Yeah, so sorry everybody there if we cut out a little bit. I think the point I was trying to end with there, Chris, was just that the traditional firms from a retirement perspective don't want to encourage the diversification and getting away from the assets that they support because it doesn't fit into their operational models. It doesn't fit into their cost structures and the way that they make money. Whereas for Rocket Dollar and any other player in the self-directed space, we really want to provide that tool and let you make your own decisions because we're not making money off the sale of those assets or securities.
Got it. Actually, I had a question come in that I'd like to just go over. This comes from one of our listeners. He said, I've researched Rocket Dollar and other self-directed IRA custodians, and I'm wondering if setting up a separate LLC entity to legally own the investments is necessary. Alternatively, couldn't it be held in a trust instead? What's the benefit of an LLC if investing only in alternative assets, such as crypto assets and crowdfunded equity?
Yeah, that's a great question. And thank you so much for chiming in with that. There are two different models when it comes to the self-directed retirement types. One is that idea of direct custody, where the trust company holds the asset directly on your behalf. And there's the Rocket Dollar model, which is supported in some other firms, but not in the same way that we really want to champion it, what allows you to have that direct access through the LLC or trust function. And so the difference is really about where the asset is held and how the decisions are made to invest in those different securities or asset classes that the listener chimed in with. So the idea would be, if you use a traditional direct custody method, the IRA custodian will have to review and approve or reject your investment request and disperse the money out for the investment and sign off on any legal documents. So if you're investing in a startup through a investment platform like Harvest Returns or Start Engine or Republic, your custodian is going to be executing those documents on your behalf and sending them the money, which can be very cumbersome and slow. It adds an additional layer to the whole transaction process. Through the Rocket Dollar vehicle, the intention is that when we do our work up front, you've got this IRA LLC that's functioning with you as the sole manager. So the account owner is the sole manager, and you're able to then disperse dollars and sign investment documents directly from an LLC bank account. So you can use an ACH connection to connect with that crowdfunding site, and you have full control to sign the investment documents on behalf of the account. So it is more efficient and has far better control, in particular if you're investing in multiple assets. So if, for instance, you wanted to buy into an early stage company with some direct stock holding, and then next to that pair some cryptocurrency assets, and maybe to go with that some stocks and bonds and a real estate investment. Making those 4 different investment types is going to be extremely challenging and slow through the standard direct custody method. Using the LLC functionality or the checkbook control, you're going to have a far easier path to disperse those funds and manage those assets back and forth.
Got it. Another question that came in from one of our listeners was, does Rocket Dollar have partnerships with platforms for not accredited investors, such as Seed Invest, Republic, Start Engine, or Fundrise?
Yeah, we do work with lots of those firms, and you're absolutely right that it's important for certain investors to consider whether it's an accredited requirement or you're able to invest via crowdfunding rules. We work with a lot of those firms. We're always proud to champion KingsCrowd and their offering on our site, and a lot of those firms work through with their site just as well, whether it's Net Capital, Start Engine, some of the interesting names that you listed. They all work with our model, and there again, where the checkbook really helps is that Rocket Dollar doesn't inherently have to have a relationship with any of those companies for your investment to get through our system. By us doing our work up front with the checkbook, you as the client are able to control that disbursement and interaction with any of those investment sites. So unlike some of our competitors that require a firm level relationship with those platforms, our model does not necessitate that. And so you can go out and transact with the newest, latest, and greatest digital investment platform that we maybe have not even had a chance to really have a conversation with yet. But we do support all of those groups, and we all share the same philosophical goal of democratizing alternative assets. So we want to explore and maximize those opportunities for our interested network, but it's not something that's required in our model.
So if you want to put $100,000 into an offline startup, you can, and if you want to put $100 into a deal on WeFunder, you also can. Is that right?
Exactly right. Exactly right. And our tool lets you do that just as efficiently in either example.
Got it. One clarification on the LLC model. Does the LLC own the entire portfolio of all the assets? That's a question coming from the crowd as well.
Yeah, it really does. It does at the end of the day. So the mechanic is that if you come through Rocket Dollar and establish a new IRA with us, we are going to be opening an IRA with our bank and trust partner, just like the other competitors in our space, where it all starts with an IRA. You always need a trust company to act as custodian. But from there, 100% of the IRA assets flow into this IRA LLC. So 100% of the cash will go into the LLC checking account. And from there, each and every investment and all uninvested cash is owned by the LLC, which the client is the sole manager of. So Rocket Dollar does not have administrative control over that entity, nor does the trust partner. The in-point client fully controls and owns all of that assets on behalf of their retirement account.
Got it. One question that I think kind of goes off of everything we're just talking about is, who is a disqualified person? You know, it sounds like if you're not accredited, that's fine. So what are disqualifications of people who can utilize this?
Yeah, that's an excellent question. For retirement accounts become complicated. So as you mentioned, there's nothing about income, there's nothing about sophisticated investor statuses or being accredited that either allow you or not allow you to invest in retirement accounts. This is open to everybody at a fundamental level. Where the IRS gets concerned about the types of transactions that are occurring is when you start to engage with yourself and your personal assets through your IRA. So a very classic example, and the number one disqualified person is, I am disqualified from my own IRA. I cannot buy or sell an asset from my personal name into my IRA. So if I own stock options in a early stage company, personally, I can't sell them into my IRA. That's a prohibited transaction and something that is going to be a firm no with the IRS. So their guidelines are that you are disqualified from your own retirement account, which means you can't transact with it, nor can my spouse, my parents, my grandparents, my children, or my grandchildren. Anybody up and down the family tree really needs to keep an arm's length away from your IRA investments. So it's perfectly permissible for me to go out and invest in an early stage company run by an unrelated third party. But if my wife happened to work there, then it becomes far more complicated and you bump up against these gray areas where you might be committing a prohibited transaction. So you really want to be careful when dealing with anybody in your family or any company or asset you might have affiliation to. It's best to keep an arm's length away from those types of situations.
Got it. So other than that, make sure you're not involved with the company, owning shares in it already, and being an employee or an owner of that company. Other than that, though, not accredited, doesn't matter. End of the day, if you want to invest your retirement dollars using a self-directed IRA, you absolutely can.
Exactly right.
Got it. That's helpful. So next question here, how much do I need to max out my contributions to my self-directed solo 401k?
Yeah, so we haven't touched on this a whole lot yet, but the Solo K is an individual 401k vehicle. So it has all the same characteristics as a corporate 401k you may have experienced as a participant. But what's really unique about Solo Ks or individual 401ks is they're tailored towards an independent earner or somebody who's earning income on the side from their normal W-2 employment. And so what it does is it allows for different areas of contributions that you normally don't have access to. IRA contributions are significantly lesser than a 401k. And so within a Solo K, you are able to make personal contributions if you're under the age of 50 up to $19,000, either in a pre-tax traditional account or a Roth post-tax account. That means me as an individual for this year, I can make a $19,000 income contribution or deferral into the 401k as an individual. There's also this ability to contribute on behalf of the company that's earning your income. So if I ran my own small business as a sole proprietor, I can defer 25% of the gross income earned by the company as part of a salary deferral or a profit sharing contribution to my plan. So if the company is earning, generally it's typically north of around $250,000 or $300,000 a year, which is a high earning threshold for a company. That's going to allow you to max out those contributions and get towards that $56,000 limit. So if you're earning a high amount through your independent income, you also can contribute your individual amounts each year. Those two things together are going to get you to those really large numbers in the 40s, 50s, thousands of dollars a year, which can be really meaningful over time.
So for someone who's making, 60, 70K out of school, kind of making a more normalized salary, how much could they contribute on a yearly basis, ballpark?
So you're still able to contribute, a meaningful number every year. And as retirement account proponents, we always want to encourage you to get something in the door if you can each and every year. So even just a few $1,000s a year, which would probably be about the amount that you're able to do with that income threshold, the compounding rate of getting, of contributing $5,000 a year, whether to an IRA or the solo K, is still is a huge boon for you in the long term. So we have a lot of folks who maybe are in that younger position who are just getting started in their careers. They're able to contribute up to $6,000 to a Roth IRA in 2019. So if you're able to max out that Roth IRA contribution, $6,000 a year post-tax is a very powerful mechanism over time. And that's where we see a lot of growth and demand coming from the younger generations in particular, are on those Roth or post-tax contributions early in their working life to really capture the long-term compounding opportunity.
And I know that you can't provide tax advice or anything like that, but there is a benefit, and I kind of know what it looks like from my own end, but there's a benefit to contributing to an IRA, right? A tax advantage that you get at the end of the year.
Yeah, so there's two different mechanisms. There's going to be pre-tax or tax deferred, where you are deferring income away and you get to write off that income because it's tax advantage on your income statement for the year. The other mechanism is a Roth or post-tax option, which is where you pay tax on it, you report it as income for the year in question, but then it's sheltered for a tax-free opportunity over time. If you take out a qualified Roth distribution, which usually requires the account to be open for 5 years, and for you to be over the age of 59 and a half. So it's a little bit of a longer game. Either one can really help you. A pre-tax deferred income can really help on that end of the year responsibility you have to the IRS. So some people manage that based on their sort of circumstance for the particular year. But either way has some powerful use cases.
And then in terms of capital gains, so you invest in a company and things go really well. What are the advantages there? Are you paying taxes on those capital gains right away? Are they sheltered?
Yeah, the great news is they're sheltered either way you go, whether it's a pre-tax or post-tax situation. The gains on any investment you make are going to be fully sheltered. And so what that means is, just like when you go out through your retirement account, let's say you buy a stock on the public markets, when you go to sell that stock, irrespective of how many days or years later, whether it would eventually be short-term or long-term gains, it all gets captured back into the retirement account. No reporting is done to the IRS on that transaction. So you're not responsible for any short-term or long-term capital gains, nor would you be responsible for any distributions or dividends you might receive. Oftentimes with some of the successful companies and some of the successful opportunities you highlight on the screen here, Chris, you might be receiving back a steady income stream from some of those particular asset classes.
Sure.
Those dividend payments or distributions will also be tax advantage. So it all will go back into the retirement account where you can continue to reinvest it tax-free until you ultimately take a distribution later on when you're in real retirement age. So that's, again, the power of the compounding, long-term duration investing, which is what works so well with these alternative assets and investing in an early stage company that you find through KingsCrowd on the Net Capital platform, let's say. Investing in that early stage company and committing to a 5 to 7 year transaction really matches nicely with the retirement timelines, as opposed to maybe a more active trader who's just going out and really active in the stock market. They may not see that advantage in the same way that an alternative investor might.
I completely agree. And this is something, again, going to, that concern around investing in startups and alternatives using your retirement dollars. End of the day, from my perspective, these are long-term investments that you should be looking to hold on to for 8 to 10 plus years, right? And hopefully, if they do well, you're going to have a really sizable gain. If they don't, you'll have a loss, obviously. But in the event they do well, hopefully it's a pretty sizable gain. Having that sheltered from having to pay taxes in the moment, that makes a really big difference on your capital gains. And I think that's really, really valuable. So if you're investing what you can, creating diversified small portfolio of startups, especially, when you're younger, maybe it's 20 or 30%. And as you get older, it goes down to 5 or 10%, and you lean more heavily on things like bonds and stocks. But when you're younger, putting a little more into these, riskier assets, but higher growth asset class, holding on to them for the long term and seeing your gains be non-tax, I think that's a really powerful way to invest in the alternative space and kind of maximize your gains. Personally, I think it's a really cool thing and a really valuable way to kind of take care of yourself over the long term. And that's why I get so excited about this, because I think even with the, the cost of opening up an IRA and managing it through something like Rocket Dollar. The reality is, I mean, those tax gains alone on one really good return on one startup could end up, more than paying for itself right there. So that's why I get excited. I just wanted to say that because I think it's a really, really powerful thing.
So you're absolutely right. And I think just the diversification of assets, it's pretty incredible how specific and how diverse you can truly get and really build that uncorrelated portfolio. I mean, you've got the list of all the different sort of options up on the screen here. What we see more and more clients doing is coming in, maybe their first investment is into an early stage company. They know
Sure.
their friend, Jane Smith went out and started her new venture. Well, I want to invest and write a $25,000 check as a sort of typical angel to Jane, my friend. That's where I start. But to pair with that, what's so powerful is the ability to go out and invest in a yielding debt instrument as well. That's maybe paying you back, a 10% consistent yield back into the account at the same time that you're waiting for that 8 to 10 year duration early stage company. And so you'll be able to do those things in a far more specific manner than buying a bond ETF or bond mutual fund that's listed through Mass Mutual or Prudential on your 401k, to your point earlier in the conversation.
No, I completely agree. And that's something I also want to be clear about. We're hosting this with you because we think there is an advantage for, investing your money into startups via this mechanism that you might find on KingsCrowd. But we don't think that's the only thing you should be invested in. Like, you should have a diversified startup portfolio, but you should also be in real estate. You should also be putting, into loans and whatnot. So you are building that uncorrelated portfolio that's more diversified. I think it's great to be across the entire gamut of investments. And the fact that you can do that in a really easy way through this mechanism, I think is a really powerful tool for people. So I think that's awesome. So next question for you, what are the, okay, there's millions of things that you can invest in, but what are the things that you can invest in with a self-directed IRA?
Yeah, so we touched on a little bit what the IRS considers disqualified parties and prohibited transactions. Those are really about who you're transacting with. In this case, we've got on the screen here a couple of asset classes that are prohibited in general, irrespective of who's involved. And they really focus on the idea of collectibles. So collectibles in general are not allowed in IRAs, and that covers quite a few areas of sort of that range. It could be a collectible car, could be certain types of precious metals or currencies, gems, precious jewels and things of that nature, art. All of those are really off the table from an IRA. Interestingly enough, in a solo K or individual 401k, some of those things are allowed, as well as life insurance, which life insurance is explicitly prohibited in an IRA, but there are some ways that it can be approached from a 401k plan. So there are some nuanced differences there between solo Ks and IRAs. There actually are some advantages to the solo K that free up some of those asset classes. But at the end of the day, what you want to consider from an IRA perspective is just avoiding those collectibles. Collectibles, insurance, and life insurance products, those are going to be a hard no. Everything else is going to be open to you.
Got it. A question coming in from the crowd. Can you talk about the risks of a self-directed IRA if the custodian goes out of business?
Yeah, it's a great question. So, ultimately the risk you're exposed to is back to the trust company and the custodian who's holding the assets on behalf of the account. And where you could have some bank risk there would be for cash deposits and assets held directly by the bank partner. If that bank was to go out of business, you'd have FDIC insurance covering it, but that would be it for the cash, right? So those same limits are going to kind of apply to our model as well. The good news with alternative asset investing is that asset is really segregated away from the bank holding company. So we talked a little bit earlier about this idea of direct custody versus the LLC or checkbook functionality through Rocket Dollar. The good news is that either way, if you go out and buy into a early stage company and your IRA owns seed shares, common stock in a new company, that private asset really has no risk back to the bank or holding company. So there's no way that asset is going to disappear as long as the endpoint startup is still in business, right? There's no the bank will never be lending against those private stocks or those private assets in a way that some traditional banks operate. And so there's little risk there to the actual position. And the good news is through a Rocket Dollar mechanism, you actually even have more control One, because everything will be held through a limited liability company. And there again, the limited liability company helps you in that the stock will be owned, Jane Smith's Rocket Dollar LLC, held directly within that LLC that she's the manager of, and once again, the only signing authority for. Whereas through the traditional method, it will be held bank, trust company, custodian for benefit of Jane Smith's IRA. And so they typically have the actual legal holding, whereas in our model, the LLC gives you additional shelter, not only from a corporate governance perspective, for instance, if you got sued by somebody out in the field, your LLC gives you that corporate coverage, as well as the fact that you own the assets directly in a legal entity that you are the only one who has control over.
Got it. Another question that came in from the crowd was, can you invest in cannabis businesses?
That is a wonderful question, and unfortunately a difficult answer right now in our industry. The real fundamental issue has been that because retirement accounts are a federally governed and regulated entity, IRS and Department of Labor being the primary oversight for those, the federal guidance on cannabis and marijuana related businesses still holds true across the board. So we as a firm, believe that it's not appropriate to hold a cannabis investment through a retirement account. There are some really specific use cases and arguments for maybe why you push back on that. For instance, if you were the resident of a state that has legalized marijuana and you were investing in a company that's based in that state that has legalized marijuana, you can make a legal argument that maybe you're not violating the guidelines. What's challenging and unfortunate is there's really no precedent for that. So there have been no IRS or Department of Labor court cases or tax court cases that would provide specific guidance on that question. So because none of us have specific guidance from the IRS and the DOL, we're really staying away from it, which is, we'll look back on this 20 years from now and maybe people will regret that sort of lack of evolution, but we feel like really the appropriate thing to do for our clients to safeguard their retirement assets is to say no to cannabis related businesses right now. But we look forward to seeing what people put through the court system and get set for precedents, because that will certainly help unlock that asset class down the road.
Great. So I know that we've kind of even run over our time a little bit. Would love if you could just give us kind of a 1 or 2 minute rundown of, Rocket Dollar, summarize it all up and say why you think this could be a valuable thing for people to utilize as they think about, growing their investment portfolio and utilizing some of their retirement dollars to do so.
Yeah, at the end of the day, this is a product, the self-directed retirement account, that has been just a niche corner of the industry. There has not been good education out across the demographics of the United States. We feel like it's a wonderful tool, and we want to bring it to everybody. Everybody deserves the opportunity to use these tools in a way that fits their own goals and situation. And what's so powerful about them is the ability to be so specific and to tailor your investments in your portfolio to you as a person and the values that you believe in. And so at the end of the day, our goal is to offer a efficient and flexible tool that gives you the options to invest in these asset classes and really manage your retirement at a far more specific level than you've ever been able to do before. And we want to provide it at a flat and transparent price that makes it easy to understand and easy to engage with. Our goal is not to sit there and chaperone you through your journey. It's to give you good education, good tools, work with partners like KingsCrowd to add ongoing value and let you just go unlock those retirement dollars.
Excellent. Well, I really, really appreciate it. This has been a terrific conversation, really informative. If anyone has any follow-up questions, do reach out to me and I'd be happy to pass them along to the Rocket Dollar team. And yeah, happy investing, everyone. Good luck with your investment strategies, and hopefully, Rocket Dollar can play a role in helping you to make informed investment decisions and grow your asset class in a more efficient way. Thanks so much, Mark. It's been a pleasure chatting with you today.
Yeah, thank you, Chris. Thanks everybody for joining us. Really appreciate your time.
Take care. Have a great day.